Welcome to Charting the Markets on this Thursday, the 29th of August. It comes around about 24 hours after we heard the news from the government that there is an intention for the prorogation of Parliament. That means everything will close down from the given date of the 9th of September potentially, if indeed Parliament ever gets that far, in the lead up to what is still planned to be the Brexit day on the 31st of October. So how do you trade these markets, and what sort of credence do we give to Brexit as a backdrop for all this, and how difficult is it to approach these markets? We're taking a look today at some of the key markets for those that are looking at the Brexit effect. We're looking at the Footsie 100, we're looking at sterling against the US dollar, but perhaps more importantly, what's happening as well for sterling against the euro-sterling cross. Well, joining us now from ZaksTradersCafe is Zac Mir himself, who will talk us through what's happening in these markets. Zac, welcome. First of all, how difficult is it to trade these markets, bearing in mind we have this big fundamental issue that's overshadowing pretty much everything that we do?
I think if you look at the charts and you look at the news flow, key events, you probably be quite hard pushed to work out when Parliament was supposed to be suspended, when Boris Johnson became Prime Minister. I don't think these factors have necessarily reflected in an intuitive way in the market. So and the other point is it's probably easier just to focus on the charts than trying to relate the charts and the price action and the news flow. I think it would actually drive you mad.
Yeah. Well, let's start off on that and talk about, first of all, this chart here, which is the FTSE 100 benchmark. And we'll take a look at the price action and ask you the question as to how you're trading this. You put on here an MACD, and you put on here as well the RSI. Now, I should also say that your RSIs have this black dotted line in the middle of them, which is the 50 level. Let's take a look at the chart first of all in the big picture. What do you want to highlight on this?
I think what I want to highlight with the FTSE is a market that I think every beginner who gets into spread betting or CFD trading, they're there at 7 o'clock, 8 o'clock in the morning. They want to trade that market and get it right. And I think the main point to notice about that chart, if you look back almost at any given period, this market loves to trade on bull traps and bear traps, i.e. you have a level of support, the market then briefly dips below it, or if it's resistance, briefly goes above it, and then it comes right back again. And we've just had that in the last few days. With
explain how these work. I'll blow this up to a full screen so we get a better idea of what's happening here. Let's talk first of all about the bear trap.
Right, the bear trap, you got that August floor, which was say 70-80, the initial one. Then the market bounced, thank you very much. You had a good, but if you look back at that, that was a few points below the June low. So people were looking at, let's say, 70-90 as support, but the market then just took out those stops, let's say, briefly broke below support level and then came back again. But what it normally does, rather infuriatingly, is it breaks a level, stays there long enough so that you think it's been broken, gets you short, and then immediately snaps back. And if you're a beginner, or if you're not aware of the way this market works, you'll go short, and then you'll stay short because it broke support. It's got to go down. Yeah. And that's the problem that you'll get hurt on. So you have that June low, let's say that's 70.95. Then you have the initial August one, which is say 70.85, and then you just see each time it just breaks the previous low and then snaps back sharply. The last one was the worst one from earlier this week, where we stayed below say 70.60 for 24 hours. So you'd think that was it. But if you look at it the other way, which is very counterintuitive, the best way of trading the market is to look at the last support, put an order to buy 10, 20, 30 points below it, and when a stop loss further back. And if you did it that way, on all those situations, you would actually be there right at the low. So that is the way of trying to conquer the Footsie, and that's something I haven't heard from anyone else. It is a bear trap, bull trap market, and it's deceptively easy in terms of you think, oh, it's just in a range, 50 to 7,200 or whatever it is. But at the end of those ranges, there's just that little overshoot, which catches out traders.
So, and talking about the bull trap, that works presumably on the opposite side. You've got
yes, exactly. Yeah. So that was 2 days, 2 to 3 days, 24 to 48 hours. Hangs above that old resistance. You think it's going to break out towards 7,800 and beyond. But it's interesting. It just gives you enough time. In fact, the last low, the 2-day low below previous support, was exactly analogous to the last high with a 2-day stay above that level. And so, but I think once you see that, you'll be much more prepared in terms of how you play your strategy. If you look at the last high, I think that we've got there, I can't see exactly where it is, but let's say it's 72.
This one up here?
No, just the last one, just in the near term.
Right,
the last high, that one there.
72.30,
yes. Yeah, 72.30. So really, the trade to do now would be to put an order at, say, 72.50 with a stop loss at least, say 72.70, and play it that way. And just with the FTSE, and you might be stopped out quite a lot, but the risk reward is fantastic because you're going to have 100, 200 point clips in that.
Yeah. Okay. Let's bring the other charts back in here, because we've also got the MACD and the RSI at the bottom. How do you trade these? What's the MACD offer?
I think the MACD offers you, if you're lucky, a crossover which will give you a leading indicator or a leading signal on the potential move to the upside. So at the moment, let's say, well, we've had the up move today, but yesterday the MACD indicator was moving towards a cross, or may have just crossed, and therefore you had an idea backing up the bear trap idea. You had an indication that today was going to be, or the next few days were going to be, going to deliver a reasonable rebound. It makes sense on a contrarian point of view that you've got all this Brexit negativity with the suspension of Parliament, and people will be emotionally short, but actually this market is going up. So that's the final piece of the jigsaw. You just look to see people have gone too bearish, it's the end of the world, time to buy. So it's a bit of the Buffett thing, be greedy when others are fearful. So on that basis, those are the three pieces of the jigsaw I would have as far as the FTSE at the moment.
Yeah, and let's look at your RSI at the bottom here.
Yeah.
And as I said at the top of the show, that you like to view this black dotted line here, which is the 50. Explain how you use the RSI.
Basically, if you go back to, let's say, the beginning of June, you had that move where the RSI went above 50. Let's say in the first week of June, the FTSE was around 7,300, and it stayed above RSI 50 until, let's say, the beginning of August. And so you could remain in your long position all that time.
So you
ignore the. I mean, obviously, from the time when it went above 50, you were looking at, let's say, nearly 400 points of profit. How much you take of that is up to you. But that was basically saying all about that time we're in bull mode, and we just ride that particular trend. At the moment, we're still below RSI 50, and so therefore, until it goes up, you would still be selling into strength according to that particular strategy. But it's one piece of the jigsaw. It's not a a sort of a idiot camera that you just use it like that. But at the moment it's lagging, in fact, the MACD that we were looking at.
Yeah. So you're buying this market, yeah?
So this market, I'd be looking for it to take out that 72.30 and probably go well, at least initially you'd be selling just above 72.30.
Yeah. Yeah, fine. Okay, all right, that's FTSE 100. Let's move on and take a look at what's happening with sterling against the US dollar. We've got the RSI on here, and you've drawn two small ellipses. What's happening for your money on cable?
Well, cable, I think my bigger picture is going on to, in terms of, let's say, taking the fundamentals first. My personal view is that 120 is the floor for this market, unless we have some horror that the market is not expecting. That includes the suspension of Parliament, that includes there being a general election, but it doesn't include probably the Corbyn Lib Dem scenario, that kind of government with a totally different economic policy. I think while the Tories are in, the market's like the Tories, 120 would be the floor for this market.
Yeah. Okay.
Otherwise, and that's what's been portrayed by the price action. We had the low, the initial low at the beginning of August around the 120 mark. Mm-hmm. We had a 2-day dip, the 24, 48-hour dip, leaving it there below 120. So you think, well, that's it, we're going to break down. Failed. It's a bear trap there. And the bear trap is shown by the bullish divergence in the RSI window and the snapback above 120, and we're still reaping the benefit of that bear trap. Basically, bear traps are the rise after a bear trap is fueled by the people who are in the short position, and they're covering their shorts. And there'll probably be a lot of people who can't believe this is still at 122, even though we've got such bad, we've got literally, demonstrations in the street. So this is really going against the grain, but markets love doing that. They love going against the extreme emotion of traders.
So what are you doing in your position?
In this situation now, would be looking for a shorting point. You can see that since May, which was the last time this market managed to get above its 50-day moving average, that's the green line there, all the peaks have been below the 50-day moving average. So at this stage, the percentage trade to do is to be selling on any spikes towards that 50-day line, which I suppose is around 123, 122.50, something like that. Yeah. You can see the RSI not able to hold above neutral 50, so that is a negative. And I think just the way that particular chart is looking, another dip towards 120, but not below that, is what we're looking at there.
And your stop?
Stop would be just above wherever the 50-day moving average is, so 30, 50 pips above that. Just
above it, yeah, fine. Okay, let's conclude and take a look at what's happening with euro sterling. And I said at the top, I mean, this is quite an interesting cross, if for no other reason other than the fact that clearly we've got these negotiations going on, and you've got both sides of the currency here with an interest in how Brexit develops. Explain what's going on. We've got another ellipse here. You've got there's a number of things going on. Right. The ellipse, the ellipse there really is just highlighting the way that the golden cross between the 100-day moving average and the 200-day moving averages got you in at the top if you were looking to buy off the back of that, which is obviously rather unfortunate. Current situation. Golden cross normally does what? Golden cross is normally a sign that the market's in a strong uptrend. So it's a buying indicator. Yes, a buying indicator. Yeah. So the only problem is that the 100-day, 200-day is obviously a lagging. It's a long period. It's a lagging indicator, and therefore, in this case, it's actually got you into the market at the top. So that's why one would take golden crosses and dead crosses with a pinch of salt. Normally, by the time they appear, you're at 2/3 of the way into whatever move you're going to get. So that tends to be the rule. So when you hear about the death cross on the S&P or the golden cross on the Dow, that's or any stock, that's what you tend to have. More usefully here, so far this market has bounced off the 50-day moving average. Yep. And the 50-day moving average tends to be a reasonably robust indicator. We had a great bounce off it at the end of July, and that took us to the peaks. Yep. And that peak is very special in the sense that that gave us bearish divergence as far as the RSI indicator. And if there is any the best use of the RSI indicator is divergence. So that's when price action moves are opposite to the RSI. So we had a classic one there where it's a bull trap and a bearish divergence. The other point to note with the RSI though which is the problem that the mistake that again the beginners make. If you look back at May, June, you had the RSI overbought for an extended period of time, and it just this market just kept on going. So that really does warn you that you've got to use you can't just use one indicator. It's always better to use two non-related technical indicators. So a bear trap and RSI is good, but not just the RSI and not just the bear trap. What else would you use in that sort of situation? What's in your preferred toolbox? That's basically, I'd say that's all I need. You just need two or more unrelated indicators. Right. So that's the thing. People normally say, oh, the RSI is overbought, I'm going short.
That's
not
that's
enough.
not enough.
Yeah.
You've got to look. I suppose the other thing to do, if you want to throw in something else, you would sort of see where was the last resistance. Is it holding above that? And so, if you were going to go short, let's say you went short at, I can't see what the level is there. In June, you would only press the button on the overbought situation once we fell back below a previous resistance. As a confirmation. At the moment, this market is stalling at the 50-day moving average, but it hasn't actually fallen below that July resistance.
So you'd buy this?
So you'd still be long while we remain above that previous mid-July peak. Let's say it's 90-20 or whatever the level is. So that's the way we would do it. But never go by just one thing.
Right.
That's really the best rule, because then you have it's just like you have confirmation, and you have and probably it gives you more confidence as well.
Okay, just one final question in terms of the direction in which you place your trade on this, because it's over 50. Would you naturally go long on this? Would you have a very tight stop?
At the moment it's on the 50-day moving average. And it's above resistance, so you're staying with the present trend. The RSI is below 50, but as we don't have anything else confirming, we only have one negative at the moment. So it's 2-to-1 in favour of being bullish. And I think if you stack things up like that, it makes you less emotional about a market. And it gives you a scientific and statistical basis for trading, not just like shooting from the hip.
Okay, where would you place your stop in a case like this? Because it's difficult, isn't it? When you are waiting for direction, you don't want to be caught the wrong side.
No, I mean, at the moment, it would be fair to buy this market with a stop loss just below the resistance of July. So just a little bit below there. So 20, 30 pips, something like that. But really, the whole point is, I mean, let's say I had an argument for going short. I'd come up with a rational stop loss, let's say just above the last high, but you have to have a rational basis. But at the moment, I'm just saying 2-to-1 in favour of remaining long.
Yeah. Okay. Zac, we'll leave it there, but thanks indeed for joining us. Zac Mir from ZaksTradersCafe. You can catch up with more with Zac on his Twitter account, looking there at some of the markets that take us through this very difficult political period, and it's an interesting time to trade these markets relating to what's happening around Brexit.